Are you missing out on one of the most powerful investing strategies for passive income? There is a type of investing that not everyone does, but can have major impacts on your future financial growth. While passive income is a term that sounds pretty sketchy, this investing strategy actually delivers. And when you're stuck working a 9-to-5 job, grinding each day, and feeling like you're making zero progress towards financial independence, it can be really frustrating. I get it, I've been there. And do you want to know what helped me get out of it? The power of dividend investing. I'm Kim, and in this video, I'm gonna share the most important steps to put together an effective dividend-earning passive income portfolio. One way to look at it is this. If you're a breeder of rare dogs, you could sell your dogs and make some good money right away. But now, your dogs are gone and you're empty-handed. But if you had kept some of your dogs so that you could keep producing puppies, then you're creating a way to generate consistent, long-term income. Rather than going for a quick buck by selling off your assets, you're building a way to continue making money in the future. Likewise, investing in dividends probably won't make you rich overnight. It's a long-term strategy. But the companies that pay out dividends, even if their value doesn't increase over time, you still have a reliable cash-generating asset that can keep paying out for many years. With these dividends, we can slowly add to our portfolio. Be careful with the yield, which is your return on investment. It can be used to estimate how much a company will give back to its shareholders, but it doesn't necessarily equate to the health of a company. Company value and dividend yield are not always directly related to each other. How about we take a look at an example? If we look at Apple stock, which has a yield of 1.46% right now, we can be pretty confident that your dividend payments will stay pretty consistent over time. It isn't a huge number, and if your focus is on making money with dividends, then you might make the mistake of thinking you should only look for businesses with the highest dividends. But that is a bad strategy. Back in 2018, DDR Corp had a really high dividend yield of over 10%. It seems like a sure winner, but in actuality, they were overrun with debt, and they had been experiencing a sharp decline in the stock price over the previous 2 years. If you only look at the yield, you might be tempted to buy, but the loss you experience in share value would make the dividend yield essentially worthless. This is a good example of something called a dividend trap. Research and due diligence are key, and you should do them before buying any investing vehicle. Checking to see if the dividend keeps going up is another good way to figure out how your return on costs will change over time. The payout ratio shows how much of a company's profit is given out as dividends so that the company can grow. It should put some money into growth, development, and research. If it pays out too much in dividends, it might not have enough money to grow the business in the future. If profits go down in the future, a company with a high payout ratio might not be able to keep paying dividends on time. The price-earnings ratio, also known as the P/E ratio, is the ratio of a company's share price, or P, to their earnings per share, or E. It is used for valuing companies and to find out whether they are overvalued or undervalued. You can use a company's P/E to determine a stock's market value and determine its future growth. If earnings are expected to go up, their dividends are usually expected to rise too. Higher earnings and rising dividends typically lead to a higher stock price. Of course, you probably want to know when you will get paid your dividends. Here are 5 important dates to keep in mind. First is the trade date, or the day you put in your order to buy or sell shares. Next is the settlement date, which is the actual date of the exchange. The third is the ex-dividend date, which is the first day a stock trades without a dividend. If you buy your shares on or before the ex-dividend date, you can get a dividend payment. Otherwise, you won't get paid until the next time the dividend cycle comes around. Next is the date of the record, which is when the company will decide if it will pay out the dividend or not. And last but not least, everyone's favorite, the pay date. This is when you get paid. Here's the thing. If you want to make money from stocks that pay dividends, remember that slow and steady wins the race. For a dividend growth investment strategy to work, you need discipline and patience. It's not a thrill ride, but it gets the job done. Dividend investing can be a great addition to your portfolio for the potential long-term passive income benefits that it provides. And this introduction is just the tip of the iceberg. If you want to go even deeper, then the next step is to click on this video where I provide a dividend investing guide to help you level up.